EPK Capital presents Daily Brief for 2nd September 2025. Hello, and welcome to your daily market briefing. I am your host, Rutvik. While Wall Street took a well-deserved break for Labor Day, the rest of the world's markets were anything but quiet. Over the last 24 hours, we've seen a political firestorm ignite around the Federal Reserve. A starkly divided economic picture emerged from China, and a dramatic power shift in the world of crypto. Let's break down what happened while America was offline, and what it means for your portfolio as traders return to their desks this morning. Today we're diving into three critical stories. First, the global market reaction to a fresh batch of economic data that paints a picture of resilience in some corners of the world and deep uncertainty in others. Second, the unprecedented political pressure campaign against the U.S. Federal Reserve, which has sent shockwaves through the central banking community and pushed gold to record highs. And finally, a massive institutional rotation in the crypto markets, where billions are flowing out of Bitcoin and into Ethereum, signaling a major strategic shift. Stick around, because this week is already shaping up to be pivotal. The global scorecard, a world without Wall Street. With U.S. markets closed on Monday, September 1st, 2025, in observance of the Labor Day holiday, global markets were left to navigate the day's events without their usual directional cue from Wall Street. For context, the last U.S. trading session on Friday, August 29th, saw a modest pullback from recent all-time highs. The S&P 500 fell 0.6%, the Dow Jones Industrial Average slipped 0.2%, and the technology-centric NASDAQ Composite saw a more significant drop of 1.2%, as some investors took profits heading into the long weekend. This left the stage open for international fundamentals to take the lead, resulting in a highly fragmented and divergent trading session across the globe. European markets ended Monday on a mostly positive note, buoyed by encouraging economic data that suggested the region's manufacturing sector may finally be turning a corner. Germany's DAX index was a notable outperformer, closing up 0.57% at 24,037.33, as investors cheered a key manufacturing report. In London, the FTSE 100 finished largely flat, inching up just 0.10% to close at 9,196.34. France's CAC 40, however, reflected a more nervous sentiment, with reports showing a close down between 0.55% and 0.76%. This underperformance points to persistent investor anxiety surrounding the country's political stability, a theme that is becoming an increasing concern for the Eurozone. Despite the political headwinds in Paris, the broad pan-European STOXX 600 index managed to close the day in positive territory, suggesting that, for now, positive economic signals are managing to outweigh political risks on a continental scale. The Asian trading session presented a starkly divided picture, where markets reacted strongly to their own local drivers. In Japan, the Nikkei 225 fell 1.24% to close at 42,360, directly impacted by the sell-off in U.S. technology stocks from the previous Friday. Major technology and investment players led the decline, with SoftBank plunging 4.81% and semiconductor equipment maker Advantest dropping a steep 7.92%. In sharp contrast, Chinese and Hong Kong markets rallied on the back of surprisingly positive economic data. The Shanghai Composite Index gained 0.46% to finish at 3,175.53, while Hong Kong's Hang Seng Index surged an impressive 2.15% to close at 25,521. This optimism was fueled by a private survey of China's manufacturing sector that unexpectedly showed a return to expansionary territory. Meanwhile, Indian markets had a breakout session, snapping a three-day losing streak. The BSE Sensex climbed 0.70% to settle at 8364.49, and the Nifty 50 index rose 0.81% to 24,625.05.13. The rally was a direct and enthusiastic response to stellar first-quarter GDP growth figures released over the weekend, which confirmed India's status as one of the world's fastest-growing major economies. The absence of direction from Wall Street allowed regional fundamentals to dictate market movements entirely. The result was not a cohesive global risk-on or risk-off day, but a mosaic of isolated, data-driven reactions. Germany's market rose on its manufacturing data, India's on its GDP print, China's on its private sector survey, and Japan's fell on a delayed reaction to US tech weakness. This divergence reveals just how much global sentiment often relies on the US as a central anchor and what happens when that influence is temporarily removed. The economic engine room, divergence and resilience. Beneath the surface of the market numbers, a series of key economic reports revealed a global economy moving at multiple speeds, with pockets of surprising strength emerging alongside clear signs of deceleration. Nowhere was this divergence more apparent than in China, which released two conflicting reports on its manufacturing sector. The official Purchasing Managers Index, PMI, from the National Bureau of Statistics, NBS, came in at 49.4 for August. While this was a slight improvement from July's 49.3, it marked the fifth consecutive month the index has remained below the 50-point threshold that separates economic expansion from contraction. This official index primarily surveys large, state-owned enterprises, suggesting that this segment of the economy continues to struggle. However, a separate private survey, the Caixin Manufacturing PMI, told a completely different story. This index, which focuses more on smaller, private, and export-oriented firms, unexpectedly jumped to 50.5, moving back into expansionary territory for the first time in months and hitting a 5-month high. This tale of two PMIs signals a deeply uneven recovery in the world's second-largest economy. It suggests that, while large state-backed industries may be languishing, the more nimble private sector is showing signs of life, possibly in response to targeted government stimulus measures. This split creates significant uncertainty for the global outlook, particularly for forecasting China's demand for commodities like crude oil and industrial metals. In Europe, the HCOB Eurozone Manufacturing PMI provided a dose of much-needed good news. The index climbed to 50.7 in August, its first reading above 50 since June 2022. This return to expansion after more than 2 years of contraction is a significant positive development, indicating that the bloc's industrial sector may finally be stabilizing and could contribute to growth in the second half of the year. Meanwhile, India cemented its position as a global growth leader. The country's economy expanded by a blistering 7.8% in the first quarter of fiscal year 2025 to 26, a figure that surpassed all analyst expectations and marked a 5-quarter high. The growth was primarily driven by robust government capital expenditure and a resilient services sector. However, this impressive performance was recorded before the full impact of recently imposed U.S. tariffs could be felt, leaving a question mark over future quarters. Looking ahead, the most critical economic release of the week will be the U.S. non-farm payrolls, NFP report for August, due out this Friday. The consensus forecast is for another tepid month of job creation, with economists expecting a net gain of around 75,000 to 85,000 jobs. The unemployment rate is anticipated to tick up slightly from 4.2% to 4.3%. This report is being watched with extreme focus because it is the final major piece of economic data before the Federal Reserve's policy meeting on September 17th. Job growth has slowed dramatically in recent months, averaging just 35,000 per month from May to July, a stark drop from previous levels. The July report showed a gain of only 73,000 jobs. A weak number on Friday would all but guarantee the interest rate cut that markets are now overwhelmingly expecting, with Fed funds futures pricing in a roughly 90% probability of a 25 basis point cut this month. The global economic narrative is clearly shifting from one of a synchronized slowdown to that of a multi-speed, fragmented recovery. The U.S. labor market is decelerating, providing a clear justification for the Federal Reserve to begin an easing cycle. At the same time, pockets of surprising resilience and even outright strength are emerging in other key regions, such as India's accelerating economy, and the Eurozone's manufacturing revival. This divergence complicates the outlook for global growth and will likely make it more difficult for investors to rely on a single, unified macro theme, potentially leading to increased volatility and a greater need for careful regional asset allocation. The political arena, a very serious danger for global markets. Over the past 24 hours, political developments, particularly in the United States, have taken center stage, introducing a new and potent source of risk into global markets. The dominant story is President Donald Trump's attempt to remove a sitting member of the Federal Reserve's Board of Governors, Lisa Cook. The administration has cited allegations of mortgage fraud as the reason for the move, charges which Governor Cook is vehemently contesting in court, calling them a pretext to undermine the central bank's authority. This action is historically unprecedented. In the Federal Reserve's 112-year history, no U.S. president has ever tried to fire a governor. The move is widely seen as a direct assault on the principle of central bank independence, aimed at giving the White House greater influence over monetary policy. President Trump has been openly critical of the Fed, demanding that it slash its benchmark interest rate from the current 4.3% to as low as 1.3% to stimulate the economy. If he succeeds in replacing Governor Cook, his appointees would command a majority on the 7-member board, a significant shift in the balance of power. The move has triggered alarm in central banking circles worldwide. European Central Bank President Christine Lagarde issued a stark warning, calling the pressure on the Fed a very serious danger for the U.S. economy and the world economy. Her reasoning cuts to the core of modern monetary policy. The credibility of the world's most powerful central bank rests on its independence from political influence. If markets believe the Fed is no longer making decisions based on economic data, but on political directives, its ability to control inflation could be permanently damaged, with severe ripple effects for the entire global financial system. This surge in political uncertainty has been a primary driver behind the recent rally in gold. The precious metal surged to a new record high, trading above $30,500 per ounce. Investors are not just seeking a hedge against economic slowing. They are specifically buying gold as a safe haven asset to protect against the perceived risk of political interference in monetary policy and the potential for long-term currency debasement that could result. Adding to the climate of uncertainty, France is facing its own political crisis, with Prime Minister François Bayrou's minority government at risk of collapse over its budget plans, a development that could destabilize the Eurozone's second-largest economy. Simultaneously, the U.S. has enacted a major shift in trade policy by eliminating the de minimis rule. This long-standing exemption allowed goods valued under $800 to be imported into the U.S. duty-free. Its termination, effective August 29th, is a direct blow to the business models of global e-commerce giants like Temu and Shein, and is expected to result in higher prices and longer shipping times for American consumers who shop on these platforms. The attempt to influence the Federal Reserve introduces a complex and counterintuitive risk to the market. The explicit goal of the political pressure is to force the central bank to implement lower short-term interest rates. However, the very act of undermining the Fed's independence could paradoxically lead to higher long-term borrowing costs for everyone. The logic unfolds in stages. First, political interference erodes the market's belief that the Fed will remain vigilant in fighting inflation. In response, investors in the bond market will demand a higher inflation risk premium to hold long-term U.S. Treasury bonds, protecting their investments from being devalued by future price increases. Because yields on U.S. Treasuries serve as the benchmark for a vast array of consumer and business loans, including 30-year mortgages, this would push those rates higher. Consequently, even if the Fed cuts its short-term policy rate, the damage to its credibility could cause the 10-year and 30-year bond yields to rise, making it more expensive for Americans to buy a house or for businesses to invest. This demonstrates the profound and often unseen danger of politicizing monetary policy. The digital frontier, Bitcoin stalls as institutions bet on Ethereum. In the cryptocurrency markets, a fascinating and significant divergence is taking place, signaling a potential maturation in how large investors approach the asset class. Bitcoin has entered what is historically its weakest month of the year on a bearish note. The flagship cryptocurrency is struggling to maintain the key $108,000 support level and is currently trading more than 13% below its mid-August all-time high of over $124,000. Technical indicators are flashing warning signs, with analysts pointing to a shooting star candle on the weekly chart, which suggests selling pressure at higher levels. Key support is now seen at $105,000, with some analysts suggesting a potential test of the psychologically important $100,000 level if current momentum continues. The most compelling story in the digital asset space is the dramatic divergence in institutional investment flows seen in August. While Bitcoin-focused exchange-traded funds, ETFs, experienced significant net outflows totaling approximately $2 billion, Ethereum ETFs saw a massive influx of capital, attracting nearly $4 billion net new investment. This is more than just market noise. Analysts are describing it as a deliberate capital rotation. The data suggests a strategic shift is underway among institutional investors. They appear to be moving away from the digital gold or pure store of value narrative that has long underpinned Bitcoin's investment case. Instead, they are allocating significant capital to Ethereum's utility narrative, which is driven by its potential to generate yield through staking and its foundational role in the rapidly growing ecosystems of decentralized finance, DeFi, and asset tokenization. This marks a sign of a maturing market, where large investors are making more nuanced, asset-specific bets based on underlying fundamentals and use cases, rather than treating crypto as a single, monolithic asset. Adding a unique political dimension to the crypto world, Monday marked the public trading debut of the World Liberty Financial WLFI token, a project explicitly linked to the Trump brand. The WLFI token is designed to serve as a governance tool for a decentralized lending and borrowing platform. However, the project has been met with controversy due to its heavy insider ownership, initial restrictions on token transfers, and its exclusive targeting of accredited investors. The launch is being closely watched as a crucial test of whether a powerful political brand can drive the valuation of a financial asset and how the market will price this unprecedented fusion of politics and decentralized finance. In other news, Solana's Alpenglow proposal has successfully reached quorum. This technical upgrade aims to drastically reduce the network's block finality time from over 12 seconds to just 150 milliseconds, a move that would significantly enhance its performance and competitiveness as a high-speed blockchain. The diverging flows between Bitcoin and Ethereum ETFs provide the first major data-backed evidence of a maturing institutional thesis for digital assets. For years, the primary institutional entry point was a macro bet on Bitcoin as a hedge against inflation. The August data shows this narrative is being challenged with substantial outflows from Bitcoin products. Simultaneously, a different thesis is gaining powerful momentum, evidenced by the billions flowing into Ethereum products. Analysts directly attribute these inflows to Ethereum's yield-generating potential and its role as a technology platform. This represents a fundamental shift in why institutions are investing, moving from a passive, macro hedge allocation to an active, yield-seeking technology platform allocation. This is a pivotal moment, signaling the start of a more complex and fundamentals-driven era for institutional involvement in crypto. Conclusion: navigating a market at a crossroads. So, to recap, while the US was on holiday, global markets traded on their own fundamentals, with strength in Europe and India contrasting with weakness in Japan and a divided picture in China. The dominant global theme is now political risk, as an unprecedented assault on the Federal Reserve's independence spooks global leaders and sends investors flocking to the safety of gold. And in the crypto world, a great rotation is underway, with institutional money making a clear multi-billion-dollar bet on Ethereum's utility over Bitcoin's store of value narrative. As Wall Street returns today, all of this sets the stage for a tense week. The market is pricing in a 90% chance of a Fed rate cut, but Friday's jobs report is the final gatekeeper. A number that is significantly stronger or weaker than the MA 75,000 consensus could trigger major volatility across all asset classes. We'll be watching closely. And that's all we had for this video. Thanks for watching. If you found this video valuable, please hit the like button, subscribe to our channel, and let us know in the comments which company you'd like us to analyze next. Just a quick reminder that this video is for educational purpose only and should not be taken as financial advice. For your personal financial advice, kindly get in touch with us on details in description, or you can connect with your financial advisor.